Good afternoon, everyone. Welcome to the channel. And today we're going to talk about how to calculate depreciation expense for a business. If you're an accountant or you're a bookkeeper or you're a small business owner, and you know exactly what I'm talking about. And for instance, and if you purchase a fixed asset for your business, and the government allow you to recoup that investment, okay, into a certain period of time, okay, during the economic life of the asset. So you can match expense coming from that asset and with any income generated by using that asset. But in order to calculate a depreciation expense, and we're going to use two different methods. I'm going to show you a straight line method, and we're going to do that in Excel, and we're going to use that function SLN. And we're going to use also markers, which is modified. The name is modified accelerated cost recovery system. But okay, and we're going to do that in Excel, and we're going to use the VDB function in order to make that calculation. And also we're going to do a small example so you can see the difference between those two. Okay, now let's talk about the straight line method. The straight line method is if you this is the most used and easily understood and in a method that exists. And if you're learning accounting, and chances are when you start talking about depreciation expense, and this is the method they teach you. And also if you're reading a financial statement, and most likely and you're seeing like a depreciation expense, and they use that method in order to make that calculation. So this is the easiest and most used and most understood. Okay, now this method is recognized by GAAP, and GAAP is the generally accepted accounting principles. Okay, that tells you what you can use, and what you can't use in your calculation in financial statement when you're doing accounting. Okay, so you use a straight line method in the financial statement, and also when you make that calculation for straight line method using straight line method, you have useful life. All asset has an expected useful life. If you purchase a vehicle, you say, well, that vehicle is going to use it as an expected useful life of 7 years. We're going to use it for 7 years in order to generate income. Okay, and sometimes it has a residual value, but not all the time. The residual value is whatever value left over after using that asset for that expected life. If the expected life is say 5 years, and under 6 year, and that asset is not entirely worth zero, so that value that in that asset is what they call a residual value. So this is mainly like the characteristics for straight line a method. But the markers method, which is the modified accelerated cost recovery system, okay, it's you use it only for tax purposes. The IRS allow you to use this method in order for to affect your tax exposure. Okay, and we're going to use that formula, that if Excel function VDB for it. Now, this method is not recognized by GAAP. You cannot use it in a financial statement. There's no way you can pick up a financial statement, a profit and loss statement, and look at the depreciation expense, and they use markers to calculate that. It's not going to happen. Okay, you use it for tax purposes only. Okay, now there's no they don't use estimated useful life, and are you going to see further below why there's no estimated useful life, and there's no residual value, because if you're using an accelerated method to recover you purchase an asset to recover the cost of that fixed asset, so the government expects you to depreciate your asset all the way to zero. And also in that markers depreciation, there's a half year convention, meaning if you're an asset that has a life, a class life of 5 years. So expect in the 6th year you still depreciate something, because the first year you're going to depreciate at 50%, and the last year that extra 50% you're going to do it in the very last year plus one. Okay, so, which is 1 year beyond the class life. Okay, now not all asset is qualified to for the use of markers. Any asset that was purchased and placed in service before 1987 can do it. You cannot use markers to calculate depreciation. Okay. And now the reason I said there's no estimated useful life, because there are different categories, and the IRS give you a list of items that fall in each category. So you have some assets fall into 3 years, some assets fall into 5 years, 7, 10, 15, and 20 years. For instance, in we get some assets fall into the 5 year category. You see automobile, light truck, and computer. Those assets fall into the 5 year class life. Okay, so if you look to the right, there's a table. Okay, that table come from the IRS publication. Okay, 946. Okay, how to which title, how to depreciate the property. Okay, and that section 179 titled special depreciation allowances is going to tell you everything you know, okay, about markers. You can also elect to depreciate your asset 100%. Okay, but that's going to have some tax repercussion. Before you do so, you have to talk with your CPA, okay, your accountant, to make sure, because if your asset is going to be used for 5 years and you depreciate it 100% at the very first year, so that means, and if you don't expect to purchase other fixed asset in the following years, so they're going to take all your tax liability will be almost zero or non very low at the very first year, but the subsequent years that your tax liability is going to be increased, because you will have no depreciation expense you can use in order to offset that. Okay, so you have to keep that in mind. So this is the table the IRS give you. Okay, and for each class year, a class life, 3 years, 5 years, 7 years, the IRS gives you the percentages that you can use in order to calculate those depreciation expense. For instance, if my asset fall into, if I have a fixed asset that fall into the 3 year category, okay, no, but let's say 5 year category, the very first year I know I'm going to take 20% of it. If the asset is going to be, is cost $100,000, $20,000 going to be a depreciation expense, and so forth. Okay, so now we're going to calculate using a depreciation using the straight line depreciation. If you're done by hand, which is easy to make that calculation, you go for the straight line depreciation, you're going to use depreciable base minus salvage value or residual value, and divided by the useful life of that asset. But we're not going to do it by hand. We're going to use the SLN function. So let's do that. We're going to use equal SLN, okay? And we're going to put the cost, okay? As a salvage value or residual value, okay? And the expected life. You close that. Here's the calculation, okay? So this is the calculation for the first year. And I'm going to put that over here. And the straight line depreciation, once you elect to do the straight line depreciation, every year you already know what your depreciation expense is going to be. Okay, there's some kind of predictability in it. So for this particular example, okay, you see a company purchased 100 equipment, $100,000. The expected life is 5 years, and anticipated residual value is 15,000. So when we calculate the straight line depreciation, and it gives us 17,000. Okay, so 17,000 for the next 5 years. But at the end of that, the salvage value, the equipment is going to be worth $15,000. Okay, now this is, you see, every year there's some kind of, every year you know what your depreciation expense is going to be. But when you're using the markers value, okay, every year is going to be different, because of different percentages the IRS give. First year 20%, second year 32%, third year 19.2%, and so forth. Okay, so we're going to make that calculation. We're not going to use a direct calculation, if by multiplying the percentage to the AI asset value. We're going to use the VDB function in Excel to make that calculation. VDB. Okay. Now we're going to use the cost. The cost of the asset is 100,000. I want to log that. Okay. The life, the salvage, okay, the salvage value. Since we know that, okay, the salvage value, there's no residual value. It's going to be zero. Okay. The life. This is the life is the class life, which is 5. Okay. Okay. Let's use this one. Class life. Okay. Now, what makes this formula a dysfunction a little bit difficult because there's what you call starting period and ending period. In the first year, okay, the starting period is 0, and the last and the ending period of the first year, okay, is going to be zero point 0.5. So we're going to use maximum, so we can make sure that we have zero point 0.5. Okay, maximum. Okay. Okay, okay, is going to be 0 beginning, and we're going to use year 1 minus, okay, 0.5. The reason I'm doing that, because we know the beginning year is 0, the starting period is 0 and the first year, but we want to have zero point 0.5 here. So we do the first year minus zero point 0.5. That will allow us to have, a zero that we want. Okay, because when you have 1 minus zero point 0.5, it's going to give us minus zero point 0.5. So when you have 0 and minus zero point 0.5, the maximum value is definitely 0. Okay, so here we're going to do that, and now we're going to use mean here. Okay, and mean, we're going to use the class life. It's not going to hurt because you're going to get the meaning, the minimum. Okay, and we're going to get year minus zero point 0.5. Okay, and we're going to close. Okay. Oh, there's a mistake that I have here. Should have been 1.5. 1.5. Okay, and I'm going to over here. Now, the next is the factor. The factor tells you you have two different options. It either one is the straight line, a straight line depreciation, if you choose one, or factor 2 if you want double declining. Since we don't want accelerated depreciation, we have to choose 2. Okay, and no switch. No switch tells you, okay, the choice is, okay, it's optional, that argument. Okay, if you want to go back to a straight line, or there's another choice if you don't want to go, if you do not want to go back to straight line. But the default is you don't want to go, since you're using VDB, you don't want to go back to the straight line depreciation. So we're going to close that. Okay, we close, enter. Okay, so now we get that the 28,000, because if we took 5 years and we multiply for 5-year class life, and you take 20%, multiply by 100,000, and it's going to give us 20%. Okay, $20,000. So we're going to do that across. The reason I put the 7th year, okay, is because I want to show you something. Because since we know, because of the half-year convention, you know, a class life 5 is going to extend to 6. That means at the end of 6 years, there should be no value left in that asset. But if, for instance, you make a mistake, you depreciate it beyond the 6 year, you're going to have that error. Okay, in order to prevent that, so you can just put an if error in that. Okay, this is the value that we want, but in case there's an error, put 0. Okay, which is with this one, and we're going to drag that over, and now we have 0. We know it should not extend to 7, but I did it on purpose so I can show you something. Okay, so in the very first year that I said you're going to depreciate 20,000. The second year is the largest of all, which is 32,000, and from that point on, and so forth. And what I'm going to do, going to see, okay, going to put a nice graph, a line graph, so you can see exactly what happened. Insert, going to go over here, going to choose this one, okay, right here, ladies and gentlemen. Okay, this is the markers, the depreciation values that you're going to use for tax purposes only. You cannot use it in financial statement. Okay, when you're preparing your taxes. Okay, that the very first is going to 20,000, and it's going to go up. Your depreciation expense is going to be to 32, and from that point on, it goes all the way. The last one you're going to depreciate something is 6, and the seventh is, and the asset is worthless. There's nothing left of value in it. Okay, so this is what I had for you today. So I hope you appreciate, you like it, and please let me know what you think. Go in the comment section, comment, and and ask questions, and hopefully I can have, I will take some time in order to read those questions. And also please like and subscribe. This channel is very new, and we have almost zero subscribers. And please like and subscribe so you can help that channel grow, and so I'll be able to bring more interesting content. So thank you for your attention, and hopefully we can see you in the next video very soon. Bye bye.